Hello, we are live. Let me just take care of a couple of things. Make sure we get the right thumbnail picture in. Okay, now you have it. Let's cue the music. Let's cue the banner. And let's get into the show. Thank you very much for joining me. I'm Mitch Goldberg. Welcome to another live episode of Be the Boss of Your Money. This is my live stream. It's all about personal finance, sharing with you the strategies, the knowledge, and lessons learned during my career about personal finance over 30 years so that I can share them with you so that you could take control of your money. Today is more like an ask me anything kind of day. So I hope you'll ask me questions, drop your questions in the comments right now if you're watching in the live stream. If not, hit me up in the replay. I'll see those. Ask your questions as if you're watching in the live stream. Enjoy it. So I've written down a couple of questions. I think I might just do this like on Thursdays, like just make it like quick topics, quick answers, get through it. Anyway, that's just kind of mood I'm in right now. I just want to answer. I just want to give you questions. I want to tell you the questions. I want to give you answers. I just want to give you so much knowledge. I am bursting with knowledge. So we are going to roll the intro. Quick intro, it's the disclaimers and all that. And then we're going to get into a really good show today. We're going to go over a couple of things. Markets hit new records today. Wow, that's cool. All right, here we go. Hey there, everyone. It's Mitch Goldberg. Welcome to my live stream. And if you're just joining us from LinkedIn, by the way, I had to just now start the stream into LinkedIn. I want to welcome you. This is my live stream. It's about personal finance. I call it Be the Boss of Your Money because I want to help you by sharing with you lessons, knowledge, skills that I've picked up along my 30-plus year career, share them with you, and help you take control of your money. And there's always some place where we could use a little bit more control. And there's always some question that you may have. So what I'd love for you to do is hit me up with your questions in the comments. I want you to stump me, actually. I want you to ask me a question that I'm stumped on and I have to get back to you on. All right. I actually like that too, because then it gives me like a new topic to learn about and research, or maybe I have to find a guest to bring on. So we're going to go through a quick update. I see you out there, Scott. Thank you very much for joining me. And I have to hang out with you one of these days because I love your, defense attorney dining posts on Instagram. They're pretty cool. So we've had an interesting week. So some of the things we covered was yesterday, how to budget like a champ. The day before, we spoke about Fed Chairman Powell and his interview on 60 Minutes about the Johnson & Johnson COVID vaccine that is temporarily pulled from the market. We spoke about the inflation numbers that came out on Monday, stock market, generally speaking, the economy. So we covered a lot of topics this week. So we've got a few more things to go over. There's just so much going on in the markets, and the world is going so haywire in so many ways, but we need to keep perspective. And the most important perspective I could give you is just chill out, keep investing for the long term, and don't let all of these things, all the news, sidetrack you from doing what you have to do, like Coinbase. Oh, crypto. Should we buy crypto? Because nothing drives people crazier than seeing everybody around them making money on something and they're not in it. You're not in it, and it's just bugging the heck out of you. Don't let these things be a distraction. These are, we're always being tested, whether you want to or not, whether if you know it or not. There's always a test that's coming your way. And when people ask me, what's your job? My job is not just to invest and keep you in the straight and narrow with a financial plan that'll make for you. It's to literally, for the next 30 years or 40 years, to prevent you from acting on your worst impulses in times of absolute fear when the market tanks and the world's going to end. And I want to prevent you from selling out of all of your accounts and going to cash and waiting for a better time to invest. And the other thing is to stop you from getting carried away with risk. I'll give you a real life example. I have one call from a client who's pretty serious about dumping everything in his or her IRA, taking that money out, paying the taxes and penalties, and just taking a shot on Bitcoin. In my opinion, this is not someone who could really afford to lose a pretty sizable chunk of their net worth. But this is what happens. People go crazy. And this client of mine, we'll say this hypothetical client of mine, okay, just to keep it on the down low, is seeing friends and relatives making a bloody fortune on Bitcoin. So, it's just for this person, I think it's a distraction, and they could be acting on their worst impulse, which is total all-out greed. And this is not a typically greedy person. I'm not knocking this person. I'm just saying these are the kinds of issues that people face when they see everybody else making money and they're not in it. And then it just becomes a FOMO, fear of missing out trade, and you want to get involved. So I want to tell you this, and I'm going to start answering questions. I've got like a whole list of questions, like, it's like hieroglyphics. Lots of questions. Okay. So we're going to start by saying this. We're in such a powerful bull market. And I've been saying this for a while now. If you're a viewer of the show, we are in a strong economy. We are having such a quick recovery now. And there's a lot of reasons for it. And yes, there are still a lot of people unemployed, 6% unemployment rate, but we have a 94% rate of employment. And you have to look at that also. And the 94% of people who are employed are actually pretty good paying jobs. It's the 6% who are unemployed. A lot of that is not the best paying jobs. I'm not knocking people. I feel bad for people who can't find gainful unemployment and are, who are suffering. But the economy on the aggregate is doing very well. It has driven the economically sensitive stocks to record highs. XLI, that's the ETF that tracks industrial stocks, industrial companies, like let's say a Caterpillar, a John Deere, a Southwest Airlines. That's been hitting highs. And that's because investors are forward looking. They jumped into those stocks hand over fist. They bought these stocks and they're riding them up. So that's why one of the things that's holding up the stock market. The other thing that's holding up the stock market are those work from home, stay at home stocks, the big ones. I'm talking FANG plus M, Facebook, Amazon, Apple, Netflix, Google, Microsoft. Those stocks are still more or less at or very close to all-time highs. And some of them, like Facebook, has been making new highs, and so is Google and Microsoft. So these stocks are moving. So these stocks haven't gone down in spite of what we talk about, which is a sector rotation from technology, work from home, stay at home, shifting into only industrial stocks, bank stocks, financials, energy, economically sensitive stocks. But as long as the FANG stocks, FANG plus M, are holding up and the other sectors are moving up, energy's up a lot this year. It's best performing sector this year. You can understand why the stock market is doing so darn well. So we hit new record highs. The Dow crossed above 34,000 today for the first time. S&P up at a new high. NASDAQ is very, very close to hitting a new high. All right, so let's get into this. We're going to do a quick review first. I'm going to go to my first screen. I'm going to make it a little bigger now before you get in there so you can see it on your smartphone. Okay, and I'll put myself in the corner here. All right, here I am up here in the corner. Okay, so Dow up over 300 points, up almost 1%. NASDAQ today up 1.31%. S&P 500 up a whopping 45 points, continuing to build on its gains when it hit 4,000 for the first time last week. We want some insurance. We want to be well over 4,000. So if we have a couple of bad days, we could say we still held on to that 4,000 mark for the S&P. That's like a new technical for the S&P 500. If we go below 4,000, people get nervous that there's a bigger pullback coming. So 4,000, the higher we get above it, the better, because it just gives us more room for down days where we're getting some insurance. It's like scoring extra runs when you're winning a baseball game. You want some extra insurance. S&P 500, NASDAQ, Dow, these are indexes. You can't invest directly into an index, but you could invest in a security that tracks or mimics an index. Gold is moving higher. I don't know if you guys noticed this, but gold has been pretty strong lately, and that is kind of thematic for an inflation expectation move up. And earlier this week, inflation came out, I wouldn't say hot, just it came out warm. Inflation beat on the consumer price index, beat expectations by just a very small amount, but the trend is definitely higher. Energy back into the low 60s, the 10-year into the 1.5 range. We were at 175, 177 yield on the 10-year treasury, now back down to 1.5. So it's kind of it's such a weird thing to see gold go up while the 10-year treasury moving down. The VIX continues to go down also. Let's take a look at the cryptos. We're going to talk about Coinbase in a minute. But, Coinbase had another good day, up $1,400, 2.37%. $1,400 is a lot, but I go by the percentage. I want to just take a look at the year high because it definitely closed off its, I'm sorry, not the day high. It's not giving me the day high here, but I'm telling you, it backed off its high of the day. Let me just pull that off my screen. Overall, the whole space of crypto did pretty well. Industrials had a mixed day, but let's take a look at some of the other stocks. I'm including Coinbase with the financials at the moment because it is an exchange. So here's Coinbase, and it was down today. It's coming up here. There you go. It was down today. It was as high as $429 and change yesterday when the stock first came out. So it's over $100 below its high of the day yesterday, and its daily high today was $349. Again, it closed at $323. Some people are thinking maybe now that Coinbase went public, some people are thinking that that crypto that's it. It's done. It's hit its high. The watershed moment happened, and excuse me, and it's over. A little sip of Dunkin' Donuts, which stock was taken over for over $100 a share. That was a be the boss of your money stock, if I may say. Yeah. So we're going to get to your comments, by the way, and your questions, and see who else is out there. Okay. Steve is out there too. Steve, thank you very much for joining me. So let's talk about Coinbase. Let's talk about Coinbase. Should you buy it? Very common question. And there's two kinds of people. There are people that are total all-in believers of Bitcoin, just Bitcoinites. You're just people who are nuts about it. And then there are people who are in the camp that this is make pretend money. It's going up just because it's going up. People see it going up, so they think there must be something to it. So I'll buy it. That makes it go up even more. It validates everybody's decision. And then the next investor is like, I have to own it. I can't take it anymore. And they get into it, and it becomes a feeding frenzy. Is it a bubble? Let me just tell you this. I've seen bubbles in my career. The most notable one was the tech bubble, 99 and 2000. But you don't know it's a bubble for sure until after the fact. Yes, I know some people are going to say it's a bubble, and when the bubble bursts, they're going to be right. But you don't know for sure. You could be 100% confident, but would you bet your life on it? All right. So should you buy Bitcoin? Coinbase. Okay. So Coinbase is your gateway to the world of crypto, because lots and lots of cryptos trade on Coinbase. Coinbase is an exchange, like a stock exchange, but instead of a stock exchange, it's a crypto exchange. They've got, like 150 million users. It's just it's become a massive company in just a matter of years. And the market cap on this thing is already up to $63 billion. It's bigger than the publicly traded company that owns, Euronext, that owns the New York Stock Exchange. So it's got a massive valuation, and maybe it should have a massive valuation, maybe not. But it's the gateway to a new world, to blockchain, and there's so many uses for all of these things. So should you buy it? And I know you want my definitive answer. Yes, you should go out and buy it, or no, you should not buy it. I know you want my definitive answer. So this is going to kind of bore you. This is really a matter of risk tolerance. And if you want to take, in my opinion, a gamble, this is very speculative. Now, as things develop in the crypto world, maybe this will turn out to be not so speculative, and there will be a higher degree of confidence in the business model in the crypto world. That'll mean the stock is probably going to be a lot higher, because you pay up for stability. Yes, you pay up for growth, but you pay up for steady growth more than pie in the sky valuation and stock. Okay, so that's the first way to look at it. So this is for speculation only. This is not for 20%, in my opinion, of someone's investment account. If you have a small investment account and you're just starting out and you're only going to own a couple of stocks and you want to take a shot, and you're of an age where you have many, many years ahead of you, I'm not going to knock you. I don't knock anybody for wanting to take a shot on a crypto or Coinbase. But Coinbase right now is the only pure play way to take a shot. Coinbase is the only pure play way to take a shot in the crypto market that you could just buy on one of the major exchanges on the NASDAQ. So what I will tell you is, if you buy it, don't invest money that you can't afford to lose. This isn't like buying Procter and Gamble. Yes, we always say don't invest money that you can't afford to lose. But when I'm looking at something like a Procter and Gamble, for example, or a Verizon, an established long-term company, long-time blue chip, I do think there is obviously a difference. And I think given time, those typically work out. I can't say for sure what's going to happen with any stock, but certainly Bitcoin is speculative. So should you buy it? If you want to take a shot, there's nothing wrong with it, as long as it suits you. You have the suitability for speculation. It's really all there is to it. Some people can take a very big bet on something like a Coinbase because they have a lot of money. And you and I could disagree on what a lot of money is. Someone could put $500,000 into Coinbase, lose it all, and they won't bat an eyelash because their net worth is so big. So you have to really decide what's right for you. I wish I could give you a better answer, but that's my answer. If you think that there's a future in crypto, even if you're not so sure about it, but it could be something that you don't want to miss out on, then go for it, as long as you could accept the risk and you have the appropriate risk tolerance to do it. That's all I'm going to say about Coinbase, okay? So the next thing I want to get into, we've got a couple of people out there. Should always make sure I close my email when I go live. It's no big deal. It just slows the computer down a little bit. All right. Well said about staying focused and not distracted, from a LinkedIn user. Thank you very much. Hey, if you're watching this and you made that comment, let me if you want, let me know where you're from. Let me know your name, because it just says on my screen LinkedIn user. Okay, and right back at you with the fist bump. All right, John is out there. I have a little cash at the side. I was advised that as it sits at the side for the next period of time, I will be losing in a big way due to the anticipated inflation. And investment returns would be the more logical place for me to keep cash due to the upcoming inflation. Well, I don't know anyone with a crystal ball, so maybe I'd love to meet that person. Okay. I think that is like the best question that has ever been asked on Be the Boss of Your Money. Thank you, John. My thoughts. Well, my base case is inflation is going higher. The Federal Reserve, and they know a lot, okay? Jerome Powell, who's the chairman of the Federal Reserve, says inflation, he expects it to be transitory, meaning we'll get a blip up in inflation, but it's not going to last more than a couple of quarters, and then we see inflation moderate again. And that could make a lot of sense, because technology for the last 40 years has been driving down the rate of inflation. Everybody gives Paul Volcker, who was Fed chairman in the late 70s to 87, when Al Greenspan became the chairman of the Federal Reserve, appointed by Ronald Reagan. But everybody gives Volcker so much credit for taming inflation. He did set the economy off into a recession, and he did squash consumer demand and made a lot of people miserable by jacking up interest rates to slow down the economy, to slow down inflation, to break the back of inflation. But the PC, the personal computer, also became available and then widely available at the same time. And I do believe that technology had much more to do with driving down inflation than any actions of any Federal Reserve Board governor over the last 40 years. Okay, just want to share that with you. The Fed's main job is their mission is bifold. They have two missions: keep inflation tame and maximize employment. They don't always work well together, but Jerome Powell, current Fed chairman, said he is really prioritizing employment over inflation. That's very bullish, by the way, for the economy, and it's very bullish for investors. So having said that, what should you do with your cash? And someone said to you, well, you're losing money because of inflation, John. I hate the answer. I hate what this person said. Okay, I'm just going to come right out with it and say that. And maybe they ask you these questions, but what is your liquidity like? You went through a pretty tough time with the pandemic. You did an amazing job pivoting your business, and you were a guest on my live stream, and we talked all about it. It was pretty incredible, and it was a very emotional time for you as well. Your lifetime of work could have disappeared in your business. So maybe you need to keep liquidity on hand in case we have another shutdown, in case the variants get worse, and all of a sudden people don't order as much, right? From you, John Robertson owns a Sexy Salad, which is a restaurant / caterer / deli, and I order food from them for my events from them all the time. John does a great job. And having said that, maybe you need to hold on to your liquidity first. That's the most important thing. Yeah, inflation could eat away at your money. It always does. But if you need liquidity and preservation is your main goal for that money, then investing it doesn't make so much sense. And there is risks to investing the money as well. So I think someone's got to totally, look at your entire picture before they say something. Oh, you should invest that money. I hope it wasn't a financial advisor who said that to you, because if it is, I'd like to give that person a good smack, because I feel like they're just trying to get you to buy something or just throw money at that person to open up an account. Oh, yeah, I have too much money. It's a personal finance issue. It's a risk tolerance issue. And it's how much time do you have until you're going to need it. Now, if you don't need that money and you've got plenty of liquidity on the sideline, then invest it. That's a different story. So we have to discover that. All right, James is out there. James, so good of you. Well said, Mitch. Ari, should you buy or not? Thank you very much, James. I'm so grateful to you, man. You're such a good guy. Thank you for sticking with me. Thank you very much. So when I started the show by saying, if you're just joining in from LinkedIn, is all these things are meant to distract you. In your journey of investing, there are going to be so many distractions that pull you away from your goal of working, saving money, investing money, compounding over the long term. That's what's going to make you, I don't want to say rich, but that's what's going to make you for retirement, okay? And you're going to get hit with endless distractions. Bitcoin is just the latest distraction. Again, if you have the wherewithal and the risk tolerance to take a shot on, the money of the future, maybe that's what it is. I'm not smart enough to know. I know the risks. I know the risks of Coinbase and crypto in general a lot better than I know the reward. I think it's like that with everything, though, because the reward is something that's esoteric in the future. But if you can handle the risk, I have no problem, with taking a shot with money that you can afford to lose. So let's go on. I want to talk to you about the rule of 72. Do you know the rule of 72? This is something I like to talk to people about. And I've posted about this on Instagram most recently with the Willy Wonka meme. 72 means if you take whatever interest rate you think you could earn on your money, you divide it into 72. That'll tell you how many years it'll take to double your money. So if you're earning 5%, so 72 divided by 5 is about 10.3. 10 years. I want to make sure I did that right. So it's a 10-year deal. Okay. So if you do 72 divided by 5, 14 years. I wish I'd said that. But if you're earning 7%, 72 divided by 7, it's about 10.3 years. That's the number I meant to give you. Okay. A little embarrassing, a little slip up there. Okay. Excuse me. So if you can earn 7%, you could double your money in about 10 years. And if you could keep earning 7%, the next 10 years, you double your money again. And if you keep earning 7%, then you double your money again 3 times while you're investing into your 401k every month and whatever other dollar cost averaging you're doing. So that's rule 72. What else? What's the difference between risk and volatility? Because people are people mix these two things up and they talk about these interchangeably all the time, but they are different. Volatility is the ups and downs of the stock market, for example, over the next 20 or 30 years. It's just ups and downs. But generally, the stock market trends higher. So if you could take the ups and downs over time, you are expected to do well in the stock market. Risk, on the other hand, is the risk of actually losing money. Well, if you're investing for the long term and you could accept volatility, you're lowering your risk. So the longer time your horizon is, the more risk you could take because you can handle the volatility. If your time horizon is short, let's say you need your money for something near term, you might not need all of your money, but if you have a $2 million portfolio and you need $500,000 over the next 2 years, well, 2 years is not a lot of time. So you could have some pretty hefty downward volatility in 2 years, but years 3, 4, and 5, the market could come back. But if you have to take that money out in 2 years, then that's risk, because if the market goes down, you're going to lose money on that $500,000. You're taking the risk. So what you should do about that is take your money out of the market, that $500,000, because the goal now becomes preservation, not growth, not earning a return on the money, just to keep it safe, stable. That's the word. So that's the difference. So the shorter time horizon, it makes things risky because you can't accept the volatility. You could take the chance if you want to, but I think you get my drift. That's the difference between risk and volatility. All right. What else? I'm going to go through one more quick point because we are going to run out of time, and I like to keep these things down to a half hour. There is a market expert who a personal finance guru, and that's okay. You're allowed to, be confident. I don't think this person is calling himself a guru, and he seems like a nice person. But there's a person out there who says credit score doesn't mean anything. It just means that you're a good borrower, and we need to all be anti-debt, anti-debt, anti-debt. But sometimes you get into debt. You buy a house, medical bills come along, you get into debt. You go to college, you go to grad school. There are a lot of reasons that are very legitimate to take on debt. I'm not saying go nuts and spend on your credit card. That's not at all what I'm saying. But a credit report is very important. And this person says a credit report is not so good. Hey, John, thank you very much. A credit report is very important. This person says a credit report is not so important. I beg to differ. I'll tell you why. I'm going to tell you why a credit report is so important. Because many jobs you apply for require a decent credit score. And if you need to rent a home, you will have to show your credit. It might not be the full credit report, but whoever is looking at that credit score wants to see that you are creditworthy, that you are going to be consistently making your rent payments. If you need to buy a car, not for cash, but to lease a car or just, buy a car and with an auto loan, your credit score is important. So for anyone to say that a credit score just means you're good at borrowing and it's not important, I vehemently disagree with that. You must take care of your credit score. That's about it. That's it for the week. So, John, thank you very much for the compliment. Good show today, as always. I really appreciate that. Thank you very much. I will be back with a new live stream on Monday. I do this every Monday through Thursday at 4:30 p.m. Eastern Standard Time. If there are any topics that you'd like me to cover, certainly let me know in the comments, either now or in replay. And don't forget to check me out on Instagram. My handle is at InstaMitchG. I'm on LinkedIn, Mitchell Goldberg. I am on YouTube. My channel is called Client First Strategy. Very simple, just named for my business. And my business Facebook page is Client First Strategy as well. So there's always a good place to follow me and to check out my content. I post on all of those channels every single day. So whichever your favorite platform is to get your content from, you can always find me. Okay. And Aaron is out there. One more quick comment from Facebook. You are a rock star. We need to catch up soon. Thank you very much, Aaron. I really appreciate that. Is very, very kind of you. And you're a rock star. And what have you ran like 15 marathons or something now? You're just like an incredible human being. All right. I will see you guys very soon. And who else did we have out there? John, Steve, Scott. Thanks all. Talk to you soon.